This Tuesday, the Bureau of Labor Statistics released their monthly report showing the consumer price index heated up in March, higher than expectations. And yet the stock market shook off the news like a bad habit. In this episode, we're going to look at why they weren't concerned with rising inflation and whether or not they got it wrong. Let's get into it. The hotly anticipated Consumer Price Index, or CPI, report was released this week, and it showed consumer price inflation coming in at the highest rate since August of 2018. The Bureau of Labor Statistics reported that the overall national average for the CPI grew 0.6% over February's index level and 2.6% over the same time a year ago. Keep in mind that the Federal Reserve's target inflation rate is 2%, so you would think that going over that target by this much might have raised some eyebrows a bit. Not at all. In fact, the stock market shook it off and set a record high for the S&P 500 the very same day the report was released. So what gives? We've had a lot of people concerned about inflation for a while now with all the money printing going on, me included. And now that it's here, no one seems to be taking it very seriously. We'll get to the reason why in just a minute, but first we'll take a look at what drove the higher numbers. Here we have the major consumption categories and the year-over-year percentage change for each. While most categories saw positive growth, energy prices were by far the fastest growing, primarily gasoline prices. Gas prices grew 9.1% monthly just from February to March, and alone made up nearly half of the 0.6% monthly increase in overall prices. There are several reasons for this strong increase in gas prices, including a reopening economy with increased travel, supply restrictions among some oil-producing nations, and a switchover from winter gasoline blends to summer gasoline blends. If you've done much driving the last few months, I'm sure you've noticed paying a bit more at the gas pump, and those higher prices aren't likely to come back down anytime soon. In addition to higher gas prices, there was also strong growth in prices for used vehicles, food, and medical care. So that covers a lot of the why we saw higher consumer prices in March, but why didn't markets react negatively to the news? If you've been following this topic lately, you may have heard people talking about higher inflation over the next few months and saying things like transitory and base effects. Here's what they mean by that. When we look at the CPI index level over the last few years, it's unmistakable to see the index plummeting when shelter-in-place orders were issued across the nation last March because of the pandemic. The first decline started in March, and so this month is the one-year anniversary of that, and the year-over-year comparison looks rather large because of the low base that you're calculating it from. That's what they mean by base effects. Over the next few months, we'll have more year-over-year comparisons that will make the price increases look extremely large. Next month, for example, even if we see a modest 0.2% increase from March to April, the year-over-year increase will still be 3.6%, a pretty high rate of inflation, but almost entirely because it is being calculated off this very low base. But after a few months, when we get to year-over-year comparisons after this recovery point, the theory is that inflation rates will look more in line with historical averages. And this is what they mean by transitory, that it's expected to be temporary. Well, all is explained, so nothing to worry about here, right? Not exactly. Let's go back to that chart and pretend that the drop-off in prices never happened, depicted here by the dashed line. If we calculate a year-over-year comparison with this, we find consumer prices still increased by 2.3%, which is still higher than the Federal Reserve's target rate of 2%. The problem is that the monthly increase of 0.6% from February to March was the highest monthly change since August of 2012. So we're still seeing higher inflation that has nothing to do with base effects, and it remains to be seen whether or not it's transitory. I hope today's video has helped clear things up with what really happened in the latest CPI data report and provided you some insights that a lot of mainstream sources just won't get into. On this channel, we go straight to the data do the analysis ourselves, and let you know what's really going on. If this has been useful for you, please give this video a thumbs up, subscribe, and share with others to help our channel grow. And don't forget to hit that notification bell down below so you know right away when our next video comes out. If you didn't find it useful, go ahead and give it a thumbs down and let us know in the comments section below that all inflation is transitory if the Federal Reserve says it is. And if Wall Street is okay printing our currency into oblivion, then I should be too. Either way, I'll see you in the next video.